Another day, another story. Creative accounting, also known as aggressive accounting or earnings management, refers to the practice of manipulating financial statements to present a more favorable picture of a company's financial performance and position. While not all creative accounting practices are illegal, they can be misleading and unethical, undermining the transparency and integrity of financial reporting. In this video, we will delve into the concept of creative accounting, its implications, and provide examples to illustrate its various techniques. Revenue recognition manipulation. One common form of creative accounting involves manipulating revenue recognition. Companies may recognize revenue prematurely or delay its recognition to manipulate financial results. For example, a company may book sales before goods are shipped or services are rendered, inflating revenue figures. Alternatively, they may delay recognizing revenue until a later period, smoothing out earnings and artificially boosting future performance. Example: in the early 2000s, software giant Microsoft was accused of employing aggressive revenue recognition practices. The company was alleged to have delayed recognizing revenue from certain software contracts, thereby inflating its reported earnings and meeting Wall Street expectations. Expense manipulation. Creative accounting can also involve manipulating expenses to improve the appearance of profitability. Companies may defer or understate expenses to artificially inflate profits. For instance, they may delay recognizing expenses, such as maintenance costs or employee compensation, to reduce current expenses and boost short-term earnings. Example: WorldCom, a telecommunications company, engaged in significant expense manipulation. The company capitalized normal operating expenses as long-term assets, artificially inflating its reported earnings. This accounting fraud led to the eventual bankruptcy of the company in 2002. Off-balance sheet financing. Creative accounting techniques may involve moving liabilities or assets off the balance sheet to obscure the true financial position of a company. This can be done through the use of special purpose entities, SPEC, or off-balance sheet transactions. By keeping certain obligations off the books, companies can manipulate key financial ratios, such as debt-to-equity ratios, to present a healthier financial position than reality. Example: Enron Corporation, as mentioned earlier, used off-balance sheet entities and transactions to hide debt and artificially inflate its reported earnings. The company's complex web of off-balance sheet arrangements ultimately led to its downfall and the exposure of one of the largest accounting frauds in history. Reserves and provision manipulation. Companies can manipulate provisions and reserves to manipulate reported earnings. By creating excessive reserves or provisions, companies can build up cookie jar reserves that can be used to smooth out future earnings. Alternatively, they may release provisions or reserves in favorable periods to boost current earnings. Example: Sunbeam Corporation, a consumer products company, engaged in reserve manipulation to inflate its reported earnings. The company improperly accelerated the recognition of revenue and released excess reserves, leading to an overstatement of its financial performance. This ultimately resulted in bankruptcy and legal consequences for the company's executives. Implications and consequences. Creative accounting practices can have significant implications for investors, stakeholders, and the overall financial markets. They undermine the reliability of financial statements, distort the true financial position of companies, and erode investor confidence. Misleading financial reporting can lead to misinformed investment decisions, stock price volatility, and potential financial losses. Regulatory bodies, such as the Financial Accounting Standards Board, FASB, and the Securities and Exchange Commission, SEC, continuously work to establish accounting standards and regulations to mitigate creative accounting practices. These measures aim to ensure transparency, accuracy, and consistency in financial reporting. Creative accounting is a controversial practice that compromises the integrity of financial reporting. While it is essential to recognize that not all accounting practices are manipulative or illegal, it is crucial to maintain ethical standards and transparency in financial reporting. Regulators, standard-setting bodies, and auditors play a crucial role in addressing the challenges posed by creative accounting. Stricter regulations and accounting standards have been implemented to enhance transparency, accountability, and the accuracy of financial reporting. Additionally, independent audits and increased scrutiny of financial statements help detect and prevent instances of creative accounting. Investors and stakeholders must remain vigilant and exercise due diligence when analyzing financial statements. It is important to understand the potential risks associated with creative accounting and to consider additional sources of information, such as cash flows, industry benchmarks, and qualitative factors, to make informed investment decisions. Ultimately, the goal should be to foster a culture of transparency, integrity, and ethical behavior within the business and accounting profession. Companies should prioritize adherence to accounting principles, maintain robust internal controls, and cultivate a strong ethical framework to ensure the accuracy and reliability of financial information. By promoting a commitment to transparency and accountability, the business community can foster trust among investors, shareholders, and other stakeholders. This, in turn, helps to maintain the stability and integrity of financial markets and supports the long-term sustainable growth of businesses. Thanks for watching.